Welcome to the Temple Bar Investment Trust AGM update, intended for those people who are unable to attend the AGM in person. If we review the last year, it was a very pleasing one, we think, for shareholders, with the share price of the investment trust and in the NAV both rising by over 12%, versus the UK market, which was up just under 8%. Notable performers during the year were stocks like Marks and Spencer's, which nearly doubled over the year, and the utility company Centrica. When added together with previous periods, this means that the return on the investment trust since Nick and I took it over in 2020 is over 90% now, versus the index of about 50%. So very pleasing results since inception. I'm going to move on now and look forward, because we think that the prospects for the trust today are still very positive despite the good performance so far. One of the first reasons for that is because we think that there is a very strong correlation between valuation and subsequent returns. The data here that we're looking at looks at the US stock market from 1928 to 2023. On the x-axis, we have valuation, with cheap on the left-hand side and expensive on the right-hand side. And up the y-axis, we have the subsequent annualized returns for the next 12 years. Broadly, the message of this chart is that when you bought the stock market when it was cheap, you made good returns. When you bought it on an average valuation, you made average returns. And when you bought it when it was expensive, you made very poor returns. In fact, in some cases, you lost money. And on the right-hand side of the chart there, you can see where the valuation of the US stock market is today. So at its current valuation, history would tend to suggest that you should expect to lose money. So US equities to us appear to be very, very overvalued. Now, if we contrast this with the UK market, the chart on the left here looks at the valuation of the UK market versus MSCI World. And again, this is a 50-year chart. What we can see here is that the average discount between the UK and MSCI World for this 50-year period is about 17%. Whereas today we trade at about a 45% discount, so pretty much the widest that we've seen in the last 50 years. And while some people will say that the UK stock market should be cheaper because of its different composition of sectors, and to a certain extent we would agree with that, that doesn't explain why, if we look at the chart on the right-hand side, we can see that the valuation of UK sectors, even when they're global sectors, trades at a big discount to their US peers. So to give you an example here, UK quoted energy companies tend to trade on about half the valuation of US quoted energy companies, with companies like BP and Shell trading on price earnings ratio of 6 or 7, compared to Exxon or Chevron on about 12 times earnings. So there does appear to be a genuine UK discount. Now, people will often say to us, you've been saying that for a long time. What's going to be the catalyst for the realization of this value? And we think that there are now two catalysts. I'm going to talk to one, and then I'm going to hand over to Nick to explain the other one. The first catalyst is corporate takeovers. The chart that we're looking at here looks at the average number of takeovers in a year over the last decade. The average across that period is about 40. In 2023, we saw that jump up to about 64. And in 24, the run rate is higher still. In fact, we have already within our portfolio seen bids for Currys, Direct Line, IDS, which is the old Royal of Mail, and Anglo American. So 4 companies, and we're only four months into the year. So to us, this appears to be overseas corporates looking at the valuations of UK equities and thinking that there's a real opportunity to make money there, and thus confirming our point that UK equities do look very cheaply valued. I'm going to hand over to Nick now to talk about the second catalyst.
The other way in which companies can generate significant value for their shareholders is by using the cash that is generated by the businesses themselves to buy back and retire undervalued equity. And this is something, this realization, if you like, is something that seems to have taken hold quite dramatically in the UK market. This chart here on page 6 looks at the number of companies in the UK which have are in the process of buying back over 1% of their market capitalization or market value in a given year. And you can see that that number has moved up very dramatically and is around 50% at the current time. So that's companies themselves recognizing that they can create value for their shareholders and drive their share prices by retiring cheap equity. And it's worth asking yourself, how is it that share buybacks create value for the shareholders that don't sell into the share buybacks? And I suppose what one has to think, by buying back shares, well, of course, what the company is doing, it is retiring or reducing the number of shares in issue. And by reducing the number of shares in issue, what it means is that for every pound note of profit that the company generates in the subsequent year is that much more valuable to the shareholders who haven't sold into the buyback. And the effects of buybacks, share buybacks over time can be extremely powerful. One of the great misconceptions in stock markets is that in order to see significant share price appreciation over time, you need to see companies grow their sales or revenues at a rapid rate. And we try to bring this to life by using the example of what some would argue has been a very dowdy company indeed, British American Tobacco. Looking at the years between the year 2000 and 2016. And we all know instinctively that revenues the revenues or sales coming out of tobacco companies are not growing at all. In the case of BAT, we look at the bar on the left-hand side of the chart there. In the case of BAT, sales or revenues grew by about 1 to 2% per annum over those 16 years. But look what happened to the share price. Second bar from the right, 18% per annum return you got from investing in the shares over those 16 years. And that's before, of course, adding your dividend. And if you add your dividend, you get a return, an annual return in the low 20s. So how is it possible to turn 1% sales growth into 20% plus annual total return? Well, the way that BAT did it over these years was by running the business tightly, successfully, increasing your profits at a rate greater than your sales, and by using your cash flows to buy back cheap equity. And by doing that, what of course you do, it means that earnings per share, which is the fourth bar in from the right, grow at a more rapid rate than profits do overall. And then, of course, the market can start to re-rate the company, recognizing that it is adding value by buying back the shares, and the share price can give you that outsized return. And it's worth putting that into some sort of longer term context. You look at the right-hand charts here, you can see that the share price started the period at under £5 and ended the period at around £50. And of course, that is, of course, before the effects of the dividend. To bring it back to today, the UK, because the UK stocks generally are looking very lowly valued, and because companies generally have recognized this and are using their cash flows to buy back equity, the so-called buyback yield, which is the return that shareholders get effectively from buybacks over the course of the year, the buyback yield in the UK is higher than in any of the other major geographies. If you add to that a dividend yield, which is also higher than that seen in the other major geographies, you get a total, what we call total yield, of 6% to shareholders. Again, and that is markedly in excess of the other geographies in the world and double the return that shareholders are enjoying in the US. So that's a That's a 6% return, a shareholder return before you've even started. And a factor which we think makes UK equities and the Temple Bar Investment Trust continue to look very attractive. Now, of course, remind yourself that these numbers apply to the index overall. So that 6% applies to the UK index overall. We are trying to cherry pick companies that can do much better than that. And buyback yields of the stocks in the Temple Bar portfolio of 10 or 12% are not uncommon. And so, as I say, so you know, that's real value being created for the trust shareholders each and every year. Again, if I try and bring it back, we try and bring it back to life, to 3 companies held in the Temple Bar Investment Trust. We pick an energy company, BP, NatWest the bank, and NN Group, which is a Dutch insurance company. Again, look how significant these numbers are. The left-hand column is the 2-year earnings yield. So for calendar 2022 and calendar 2023, what proportion of the market value of the company was generated in the form of earnings for the company's shareholders? And then you can look at the right-hand column and you can see of those earnings generated, how much was returned to shareholders. BP in those 2 years generated just over 40% of its market value in earnings for its shareholders. And it returned 26% of that, 26% of the company's market value, so just over a quarter, in the form of a dividend. That was 9%, the second column in, and 17% was returned through the mechanism of a share buyback. These are really powerful numbers. Look at the NatWest number. Over 40% of the company's market value was returned to shareholders in those two calendar years. So this is, this is real value being created, and should result in incremental share price gains over the medium to long term, just in the way that we described with BAT a little earlier. And of course, it's why we think that the investment trust is set to give you continued attractive level of total return. So in summary, what are we saying? In summary, we're saying that there are many areas of the market, the US equity market in particular, which appear to look expensively valued when looking at historical valuation measures. Whilst at the same time, UK equities, because of neglect, seem to be particularly undervalued at the current time. In the absence of money being allocated to UK equities, this value can be realised in one of 2 ways. It's either through corporate takeovers, and we've seen a significant step up in those, or through companies taking matters into their own hands and buying back their own cheap equities. Investors ignore the impact of a total return approach, making the mistake of believing that you need rapid revenue growth in order to enjoy very healthy investment returns. And finally, just to reiterate the point that at current valuations, share buybacks are extremely efficacious and drive substantial incremental value to the investment trust shareholder.